What's up, everybody? This is Sunko, the Korean bro. May, June, July, August, September, 2/3. And let's see, okay? Hmm. Could AI-driven travel reservation support rate off for booking holdings? Hmm. One top small cap cheap stock that could be poised for massive gains. Hmm. Okay, three last known Medicare rules everyone should be aware of. Um. Okay. Let's look at article this one first. Okay. Could AI-driven travel reservations and support pay off for Booking Holdings? Booking Holdings is reshaping the travel booking experience with artificial intelligence, enhancing customer satisfaction and its competitive edge. Enhancing customer satisfaction and its competitive edge with artificial intelligence, AI integration, speeding up response times for customer inquiries, and helping make more thoughtful travel decisions. The strategy implementation of AI technologies could position Booking Holdings stock as an attractive investment. Find out how AI technology helps Booking Holdings shape the future of travel. Within the ever evolving realm of travel and technology, Booking Holdings continues to harness artificial intelligence in an attempt to redefine travel booking. Smart investment warrants that look into Booking Holdings' strategy implementation of AI, its reshaping of the booking experience, along with the advantages it offers and the potential challenges faced. Yeah. Examining Booking Holdings initiative. Booking Holdings is a major player in the travel industry, strategically integrates AI into its array of travel services, including renowned brands like Kayak and Booking.com. Uh, this integration signifies a pivotal shift in how travelers interact with the Booking Holdings platform. Kayak, for instance, introduced an AI-powered virtual travel assistant driven by OpenAI's ChatGPT. This AI-powered assistant empowers users to engage in natural language conversations with the platform. The company says this tool transforms the traveler's booking experience, simplifying and personalizing the travel planning process. The strategy advantage for Booking Holdings here becomes evident by enhancing user experience and bolstering its overall competitiveness in a crowded booking market. Booking.com, another key component of the Booking Holdings portfolio, follows suit with its AI trip planner, which relies on OpenAI's ChatGPT API to introduce conversational elements into trip planning. Travelers can pose travel related questions, receive tailored recommendations, and craft intricate itineraries. This move underscores Booking Holdings' dedication to employing generative AI to deliver user centric and data driven insights and to enhance their travel experiences. It is an all ChatGPT Booking Holdings subsidiary. Priceline joined forces with Google Cloud to bring Google's powerful AI tools into play, allowing travelers to have natural conversations on that platform for trip planning as well. The partnerships also simplifies customer service, helping agents navigate potentially tricky cancellations and rebooking rules with AI assistance. This has the potential to add a new layer of service to Priceline bookings and cut down on potential labor expenses associated with complicated rebooking. The state of the connected consumer report from Salesforce shows around 3 out of 5 customers prefer to handle simple issues themselves and slightly more expect immediate responses when they reach out to a company. Grasping the AI advantage, these initiatives go beyond simple research or development work as they could become a major part of Booking Holdings' competitive edge. By embracing AI, Booking Holdings simplifies many of the regular hurdles of travel planning, making it more accessible and enjoyable for all users. This improved experience can translate into enhanced customer loyalty and subsequently higher revenue through bookings. According to a recent Salesforce Snapshot research survey, approximately half of respondents said they have used generative AI. Around the same number also agree they would use the technology more if it were simpler to use or integrated in tools with which they were already familiar. AI driven personalization can help build both customer loyalty and per customer revenue, propelling consistent growth metrics such as gross travel bookings, room nights booked, and total expenditures on each platform. Using a data centric approach enables Booking Holdings to optimize user experiences, fostering brand loyalty while remaining conversational and accessible. Challenges and drawbacks of navigating the AI landscape. While the integration of AI brings significant benefit, it also presents formidable challenges. AI-driven systems demand substantial investment in technology, infrastructure, and talent. Ensuring data privacy and security remains paramount, especially in an industry handling sensitive customer information. AI is not impervious to occasional glitches or misinterpretations of users' inquiries, potentially negatively affecting the customer experience. Maintaining the delicate balance between automated assistance and a human intervention poses a challenge. As the AI adoption grows across industry, competition intensifies. Rivals also exploring AI solutions could potentially erode booking holders' competitive edge if not met with a continuous innovation. Booking Holdings' foray into AI signifies more than a mere technological upgrade. It's a strategic maneuver to solidify its position as a travel industry leader. For investors, understanding the strategy adoption of AI provides valuable insights into Booking Holdings' growth potential and a dedication to delivering exceptional travel experiences that can drive consumer loyalty and growth. In a world where technology and travel rely heavily upon one another, Booking Holdings' embrace of AI positions the company as an enticing investment option. While challenges exist, Booking Holdings' diversity of options and commitment to innovation make it a noteworthy player in the often turbulent travel landscape. Therefore, investors keen on the long-term potential of AI-driven travel solutions may find Booking Holdings an attractive prospect. One type small cap chip stack that could be poised for massive gains. Open G. A smart home speaker, a wearable device like a watch or earbuds, or some other type of equipment hooked up to network may come to mind, but is that definition too narrow? Small IoT chip designer and G thinks so too. Today, the radio frequency technology that the company helped pioneer has connected tens of billions of random items to the internet. Yeah. Meta Platforms introduced several new generative AI features at its Connect conference in September. Meta can use AI to drive engagement while making it easier for business to reach new customers. All of Meta's AI tools are built on its limited model, which already has a lot of traction with developers. And seeing what Meta built could drive more developers to use it over other foundational models. That benefits Meta in a couple of ways. First, more developers tinkering with Llama 2 opens the door for new and innovative ideas that Meta could implement itself. It could be anything from a more efficient model, a more task specific model, or even new applications. Llama 2 is already one of the most competitive generative AI models in terms of performance. There's very high potential for Meta to leapfrog the competition to introduce a better platform than its competitors. Unlike many other AI competitors, Meta has AI strategies within its business to fuel revenue growth in two key ways. When you combine these, it has massive potential: increase engagement, make advertising easier. As noted, consumer facing AI applications can get users to spend more time on Meta's family of apps and even push users to curb its apps. For example, the prompt "Show me a good dinner recipe for tonight" could have a Meta's AI assistant send a user to an Instagram post. Next, Arrow Energy. Hmm. Let's look at this one, Disney and Roku. Staying the streaming arena, Roku also looks like it's priced for irrelevancy, and that seems like a mistake. Shares of the streaming distribution platform are down more than 85% in 2021. That's not justification alone for buying the stock, but the conditions that led to that sell-off are mostly temporary. Growth in the digital advertising market has stalled after boom during the pandemic, and the company mistimed the ramp up in spending in 2022, just as headwinds in advertising were forming. However, the ad market is starting to come back to life, as it seems like there won't be a recession, or at least not a major one. There's now a raft of new ad-supported streaming tiers, including from Netflix, Disney, and Amazon, that opens a vast market for Roku. The company typically takes 30% of its ad inventory from streaming partners on its platform to sell itself. The company is taking steps to control costs and return to profitability, at least on the basis of adjusted earnings before interest, taxes, depreciation, and amortization. Last month, Roku said it will lay off 10% of its workforce, or about 360 people, in its third round of layoffs this year. It plans to remove original content, taking a one-time $65 million charge in the process. The entire streaming industry has overspent on content, so it's not surprising to see Roku making such a move. The company also expects to return to positive adjusted EBITDA for the full year 2024. Despite the challenges in the business, usage on the platform continues to grow, a bullish signal for its long term performance. Active accounts rose 16% over the last year to 73.5 million, and streaming hours were up 21% to 25.1 billion, showing that demand for Roku services continues to increase even if ad growth has been sluggish. At this point, the stock trades at a price sales ratio of just 3, which looks like a great price to pay for a market leader in a growing industry, especially if advertising demand continues to recover. Okay, let's look at this one, Datadog. Okay, Wall Street is divided on whether a new bull market is underway, but it's united on the stock. No matter which camp is right, history proves the stock market rises to new highs over the long term. Cloud monitoring stock data dog gets a majority buy rating. Okay. June 2022 marked the official beginning of a bear market as the S&P 500 index closed 20% below its all-time high, which met the technical criteria. Wall Street was in agreement and the index continued to slide until October. But the S&P 500 has recently traded more than 20% above that October low point, which prompted some analysts to declare the beginning of a new bull market. Others disagree, though, because they believe the index needs to reclimb its previous all-time high before the bulls are back in charge. No matter which camp is right, history shows the broad market will rise to new heights over the long run. And while the street is divided on the official classification of the market, it does have a clear bullish consensus on one stock. The Wall Street Journal tracks 37 analysts covering cloud monitoring stock data dog, and the majority have given it the highest possible buy rating. Here's why. Datadog just added artificial intelligence to its platform. First, what is cloud computing? Businesses use store their data and host their websites by maintaining physical server hardware on location, which was expensive. Today, tech leaders like Amazon and Microsoft manage enormous centralized data centers the business can rent for a small fraction of the cost. Business can store their data and host their online sales channels without owning any physical infrastructure. That is, they can operate in the cloud. But with so many facets of an enterprise now running online, tracking things like technical faults or even customer satisfaction requires specialized tools, and that's where Datadog comes in. A business might be completely unaware its website is down in one specific region of the world, or for one specific group of customers until it notices a drop in sales. Datadog's cloud observability platform monitors for those issues around the clock so the business can rectify them before they affect the customer experience. And now, thanks to a new generative artificial intelligence tool, it's easier than ever to drill down to the root cause of a given problem. It's called Bits AI, and it serves as a chatbot that is embedded in the Datadog platform. Operators can converse with Bits AI to identify, diagnose, and rectify faults far more quickly. It's effectively a hyper intelligent assistant that knows the business network inside and out. That isn't the only way Datadog is exploring AI. Just launched an observability tool specifically for developers of large language models, which are foundational to generative AI applications. Just launched an observability tool specifically for developers of large language models. It can help them track the cost and the accuracy of a model in an automated fashion, saving hours of manual legwork. Hmm. Datadog expects a slow end to 2023, but there are positive signs on the horizon. The last 18 months have been marked by elevated inflation and rising interest rates, which have increased the cost of doing business. As a result, most software companies have seen their customers trim back spending and focus on optimizing their digital infrastructure for efficiency rather than investing in growth. In the second quarter, that trend prompted Datadog to reduce its full-year revenue guidance to a range of $2.05 billion to $2.06 billion. Good news, the company is seeing evidence this tough period is coming to an end, which means it could experience a re-acceleration in the new year. With all of this said, Datadog's growth is still quite robust. Its second quarter revenue of $5.09.5 million was up 25% year over year, and it also saw a 24% jump in the number of customers with annual recurring revenue of $100,000 on its platform. This shows larger organizations view cloud monitoring as increasingly crucial and even a value add to their business, which bodes well for Datadog. The company is also carefully managing costs, and its second quarter net loss came in at just $3.9 million. The company is treating water through this difficult economy and is waiting for the right time to start reinvesting more aggressively in its growth. With over $2.1 billion in cash and marketable securities on its balance sheet, it is equipped to do so. Very bullish in data. Like many tech stock, Datadog peaked during the tech frenzy of 2021 when interest rates were at record lows and the US economy was thriving on trillions of dollars in economic stimulus. Its stock is currently trading 52% below their all-time high, which might be a great long-term opportunity for investors. As I mentioned above, the journal track 37 analysts covering the adult, and 20 of them have given it the highest possible buy rating. Another 7 are in the overweight camp, while 10 recommend holding. No analyst recommends selling. Their consensus price target of one of $5.36 implies an upside of only 15% from where the stock trades today, but that's based on a short-term outlook. And many experts believe the Federal Reserve will begin cutting interest rates in mid-2024, which could drive more confidence in the corporate sector and among investors. Lastly, cloud computing will only grow its reach as time progresses, especially because the cloud is where most AI applications are now being developed. Datadog clearly has its finger on the pulse of that trend with its new tools, so investors might do well to heed Wall Street's recommendation and own the stock ahead of the next bull market whenever it does come. So here we talked about Datadog and Datadog. Okay. And what I just talked about was Roku, right? Roku. Three safe ultra high yield dividend stocks are surefire buys in October. Verizon Communication Ultra Group. Uh, Lisa Khan and the FTC have been planning this suit for a while. Amazon has multiple business segments that work well with each other. The e-commerce portion of Amazon isn't what most investors would want to own. The FTC and 17 state attorneys contest that Amazon uses unfair practices to maintain a monopoly, including suppressing sellers, offering low price items in its search results, conditioning sellers to become Prime eligible. Okay. Obtaining a monopoly by superior product, innovation, or business acumen is illegal. However, the same result achieved by exclusionary or predatory acts may raise antitrust concerns. Hmm. C3.ai is far smaller than Tesla, with a valuation of just $3 billion as of this writing. The stock has been extremely volatile since it was listed published in 2020. After reaching an all-time high of $161 per share, it plunged 93% to just $10 and now trades at $25. The point is, C3.ai might present more risk than many inventors are comfortable with. But if the company can execute a strategy, it could also create substantial value in the long term. C3.ai is a pioneer of the enterprise AI industry. It was one of the first companies to sell ready-made AI software and has built a portfolio of over 40 applications designed for business in several industries, including financial services, manufacturing, and oil and gas. American multinational industry uses C3.ai to monitor 300 different assets, and the technology produces 4 million predictions per month to resolve equipment issues and manage its supply chains more effectively. Similar, the defense department is using C3.ai to improve readiness in decision making. It's driving 25% increase in overall aircraft missioning capability, enormous cost savings thanks to accelerated predictive maintenance. Okay, okay. Oh. Falling utilities, raising yields, weighing stocks. Big tech takes a backseat after the AI hype cycle. Hmm. Throwing the word AI around isn't what it used to be. The biggest names in tech drove stock market surges this year, pivoting from the cold everglow of cost-cutting layoffs to riding high on its exuberance of AI. But the mega cash stocks that led the way won't be what takes the S&P 500 higher on its next journey upward. It will be the other 493 companies with much lower valuations, but higher potential to outperform, honestly, without the baggage of inflated valuations or the pain from the tumble after the AI run up. Opportunities for value stack cycle equals beating down industries lies in the S&P's waiting. Boomer investors, Bill Ackman says Fed rate hikes are likely over, but warns a big threat still looms. Okay. Bill Ackman said the Fed is likely done hiking interest rates as the economy starts weakening. High mortgage rates, high car rates, high credit card rates, they are starting to have an impact on the economy. The vulnerable investors are also betting that 30-year treasury yields are going to rise further. Bill Ackman, CEO, said that the Federal Reserve is likely done hiking interest rate as the economy begins to signal a slowdown, but warned spillovers effects will continue. The central bank has lifted rates 11 times since March 2022. To hose down inflation that had been running at the hottest pace of in 4 decades. Inflation has since cooled sharply, but the latest reading on consumer prices showed a 3.7% annual increase, still above the Fed's 2% target. The Fed kept rates steady its meeting last month, while signaling that future hikes were not off the table. But Atman doesn't expect any more. I think the Fed is probably done. I think the economy is starting to slow. I think the level of real interest rates is high enough to slow things down. High mortgage rate, high car rates, hard credit card rates, they're starting to have an impact on the economy. The economy is still solid, but it's definitely weakening. So even as the Fed hits pause, bond yields could keep rising as the market prices and these prospects of a high inflation added. On Monday, the 30-year Treasury yield surged 9 basis points to 4.8%. The 10-year yield jumped as much as 13 basis points to touch 4.7%. Ahmed told CNBC he sees the 30-year yield continue to rally into the mid-fives, but doesn't expect the 10-year yield to go meaningfully above 5% as the economy has shown with signs of weakness. Structural inflation is going to be persistently higher. In a war like that, the government shouldn't be able to borrow at 4.75 fixed for 30 years, he said, echoing his call from August when he revealed he was batting against 30-year Treasury, citing stubborn inflation. Meanwhile, mortgage rates have all shot up in the past year and a half, along with U.S. bond yields weighing on real estate markets. I'm pointing out that most homeowners and many large businesses borrow at lower fixed rates for the long term. But the problem is for those who borrowed over shorter time horizons, who have borrowed shorter term at a fixed, low fixed rate, who are getting repriced. You look at a lot of commercial real estate investors are going to have a very challenging period. It's really a big threat. Fourth quarter typically positive for stocks. Okay. Don't be fooled by the bears. Okay, the bulls took hold of the stock market narrative at the start of the year and charged ahead all the way into midsummer, but since then the bears have been rather noisy. On the back of rising oil pricings, fears of interest rates staying high for longer than hoped for. And the possible prospect of a recession still looming, the markets have been shaky and have been handing back prior gains. However, against the backdrop of a Goldilocks economy, billionaire investor Ken Fisher thinks it's all just repeat of a scenario that played out earlier in the year. Recall how at the start of the year, dire bearishness with expectation of a recession was involved, says the Fisherman Investment Founder. Since spring 2022, bears war Fed hikes with a list of other wars, Ukraine and Silicon Valley Bank among them, would kneecap GDP, which they believed necessary to slow inflation. Okay. Okay, this is it for today, and I'm gonna see you tomorrow. Okay, see you and have a good night. Bye bye.